Hi, I'm Satya Sontanam from the Hindu Business Lines Research Bureau. On the mutual fund side, the recent development has been that the fund house Parag Parikh Mutual Fund announced that its long-term equity fund scheme will write call options under the covered call strategy with effect from October 14 this year. Why now was one of the most asked investors' queries on this move. The fund house explained on their website that their investment team saw unusually high option prices in June 2020 but could not avail of those prices since their offer document had not incorporated any provision for such positions then. Therefore, they are changing their offer document now to enable them to enter into such positions when the timing is right. But what is a covered call strategy? In this video, our technical analyst Akhil Nallamuthu will explain to us what it is. Hi Akhil, can you explain to us about the covered call strategy in the trading parlance first?
Sure, Satya. Covered call strategy involves creating a trade or an investment position combining stocks and its call options contract. As the name suggests, we are covering our stock holdings by selling a call option. This way, we are reducing our cost by receiving the options premium, and it can also act as a hedge equivalent to the premium at which we sell the call option.
Okay. I think an example will help us understand the concept better, Akhil. Say a mutual fund scheme held stock X which was bought at 1000 rupees. Now the fund house entered into a covered call strategy by writing a call option on stock X at a strike price of 1100 rupees for an option premium of 50 rupees. Can you explain to us what would be the gain or loss to the fund house in various scenarios of market price movement?
Okay, let's say on expiry, the stock price stays below the strike price of the options contract. In our example, the strike price is at 1100 and let us consider the stock price is at 1050. In this case, the options contract will not be exercised.
Oh, yeah, because call option contracts get exercised only when the market price is above the strike price, right?
Exactly. So in the scenario we just considered, the profit will be 100 rupees. That is, you have gained 50 rupees as the stock appreciated from 1000 to 1050 and another 50 rupees in the form of options premium. But if the stock price falls to 900 rupees, the loss because of the decline in stock price will be 100. But since you have received a premium of 50 rupees by selling call option, the net loss will only be 50. If you had not sold the call option, the loss would have been 100. Essentially, the difference between the stock purchase price and options premium collected will be the break-even price. In our case, the break-even price will be 950, meaning you will start making loss once the stock price depreciates below 950. But if you had not sold the call option, the break-even price will naturally be your actual purchase price, which is 1000. So here, by selling call options, we have brought down the cost of purchase. Let's look at another scenario where the stock price is above the strike price on expiry. Say the stock price is at 1200. As a seller of options contract with a strike price of 1100, no matter where the stock price is on expiry day, you are obliged to sell the stock at the strike price. In this case it is 1100. But still you would have gained 100 rupees as stock price appreciated. In addition, you had already received the premium of 50 rupees. So the total profit will be 150 rupees. The catch here is that no matter how far the stock price appreciates above the strike price, your profit will be limited to 150 rupees. The trade-off by going for covered call strategy is that for reducing the cost, you are sacrificing the profit potential above 1100 rupees.
Akhil, from last year, trading in futures and options in India was shifted from cash settlement to physical settlement, right? Will that in any way impact the profit?
Not really, Satya. So far, our examples were based on physical delivery. Had they been cash settled rather than physically settled, the profit will remain the same, but the cash flows could vary. Let's take the example where the stock price is at 1200 on expiry. Under cash settlement of options contract, on the expiration day, you need to pay the counterparty the difference between the current market price of the stock and the strike price. Here, the market stock price is at 1200 and the strike price is at 1100. So, the cash outflow for settling the options contract will be 100 rupees. But the notional gain on the stock that is held by you is the difference between the current market price and the purchase price, which will be 200 in our case. So here the inflows will be 200 rupees that you gained by buying the actual stock plus 50 rupees that you received by selling the call options. It adds to 250 rupees. But you have made a loss of 100 rupees by settling call options contract. So the net profit will remain the same 150 rupees, which was the case with the physical settlement.
Akhil, in this covered call strategy, looks like the benefit is limited but the opportunity loss could be infinite. Am I right?
You're right, the benefit is limited, but the advantage with selling call options is that you will make a profit equal to the options premium even if the stock price remains at the same level until the expiry. So, on the whole, it depends on the fund manager's view on the stock. If the manager expects the stock to be sluggish or moderately bullish or even a minor correction in the stock price, covered call can be the best strategy.
Understood. This is what explained to us by the fund house as well. They say they'll write the call options only for those stocks which they believe will have limited upward movement in the near future. The fund house also indicated that if the market price is unfavorable to them on the date of expiry, they would either square off or roll over the position. Now, as we understood what covered call strategy is, let us get into a few procedural aspects. Mutual funds can write call options only on those stocks which are part of Nifty 50 or BSE Sensex. This means out of the 26 stocks that the Parag Parikh's long-term equity fund scheme is holding, as per the August fact sheet, a covered call can be written only on 7 stocks. And these include Axis Bank, Dr. Reddy's Labs, HDFC Bank, Hero MotoCorp, ICICI Bank, ITC and Sun Pharma. There is another condition. The total number of shares underlying the call option cannot exceed 30% of the shares of a particular company held in the scheme. That is, say the scheme is holding 100 shares of company X. As per the regulations, the call option can be written on only up to 30 shares of company X, provided those 100 shares are unencumbered shares. Also, the total notional value of options cannot exceed 15% of the equity value of the portfolio. The fund house claims that the use of the strategy will be selective and depends on the extent of mispricing or opportunity that they see in the options market. If the existing shareholders are not happy with the changes in the scheme, they are given an option by the fund house to redeem or switch to another scheme of the fund house on or before October 13, 2020. Unit holders who do not exercise the exit option on or before October 13 this year would be deemed to have consented to the proposed modification. That is it about the covered call strategy. The market regulator SEBI, the Securities and Exchange Board of India, allowed mutual funds to take such strategies only from January 2019. We will wait and see if more fund houses follow the suit of Parag Parikh Mutual Fund in adopting such a strategy.